The views expressed on the following program are not necessarily those of this station, its owners, staff, or management. The following program is sponsored by Citizens Financial Security. In a world where information is power, the original Money Doctor inspires you to rise above it all and plan ahead with guaranteed success. William F. Richardson is the original Money Doctor.
Hi, this is William Richardson with your Principle of the Day. Previously, we talked about the American Dream, and we also discussed in that session about home equity and protecting our nest egg from loss, and also having ability to have liquidity, choice, and control, and a fair rate of return. Today, we're going to focus on the topic of forgotten equity, equity in your home. Paying off your mortgage may be a mistake. Is your house unemployed? I could tell you, most of the people listening, your house is probably unemployed. Now, have you ever thought about your house being an employee for you? If you are an employer, that may resonate because you know that you hire people and pay them money because they're going to, what? Give you a rate of return. You put money into an investment for rate of return. You purchase that real estate because you want it to go up in value, which is a great thing. The issue is how you have access to that equity, because equity itself has a zero rate of return. Your equity is going to grow the same if it's in the house or in a separate account. And your choice is determine where you want to be at. And the last segment, we were talking about the family dream, where 95% of Americans are not wealthy. Only 5% of Americans are actually wealthy. What are they doing differently? Well, when you look at what they're doing differently, one of the key areas is how they finance the property, how they borrow money, and how they use debt as a wealth strategy vehicle, because they're disciplined. They don't borrow money and allow it to grow and not have a means to pay it off. And generally when they're borrowing money, they're using it to make money. So they use other people's money to make more money of their own. So looking at employment of your vehicle, which is your house, what happens when you're unemployed, when you don't have a job? When's the last time that you needed money and you weren't working and you went to a financial institution and said, I'd like to borrow some money? What did they say to you? Well, come back when you have a job. What did they say to you when you had a low credit score? You don't qualify for that much money. So the equity that's in your house, it's only accessible to you when another institution feels that it meets their criteria. So when do you want to get the money out of the house? The best thing to do is never allow it to accumulate into the house. So to use proper loan strategies to not grow the money there. And how do you do that? Well, you're talking to your mortgage broker, and you'd look at different types of loans. So you could have a 15-year loan, a 30-year loan, or an interest-only loan. And a lot of times we will look at using an interest-only loan, which means we're paying no money down on the house at all. We're taking the difference between the 30-year and the 15, and we're putting that into a side fund and allowing it to grow at a rate of return that in most cases actually allows us to pay off the house sooner than if we just went with a standard loan for 15 years. Now, you can hear on a lot of talk show hosts that they'll tell you to pay your house off as soon as possible, use a 15-year loan to do that, and sock all the money in there. When you're doing that, remember, you're becoming the 95% of America that are not financially independent, because they're saying debt is a cancer. And debt can be a cancer if you are undisciplined. So if you will take equity out of your house and you're going to buy a car, a boat, or go on vacation and use it as an ATM, like a lot of people did prior to the crash in 2008, and actually lost their homes because of what they did, because of the way that they borrowed money from the institutions and weren't educated on what they were doing, then yes, I would say that information could be best for you. But if you can do what some of the smartest money managers are teaching and financial strategies that are outside of the normal, because if you're doing normal, what's going to happen? You're going to be like everyone else. And so if you want a chance to be in that 5%, you need to be disciplined. And one of the areas to be disciplined is, if you are not wealthy, is what do you have? You have your house, you have the equity, you have a retirement account, you have a little money you put in every single month from yourself. Maybe your employer matches it. And what do we say there? Take the match. Always take the match in your retirement account. But you can probably do better over that into a proper side fund with the equity from your house. Allow that to accumulate and to grow and to use that when you need it most. So when we siphon off the equity from our house, and we're doing this in a proper manner, under management, with knowing that you're working with a broker who understands what they're doing, and you're working with where you're investing the money with someone that understands what they're doing and is specialized in equity management, which is really key, because some people got themselves into trouble back in the late part of 2008 and 2005 with just doing things with people that were not educated correctly. So when we go back and we're listening to some of the talking heads, and they're saying to you, pay your house off in 15 years, take that money, dump it all into this account and that account, and then let it grow. If you do that, you're putting yourself at risk of having your house unemployed. You're putting yourself at risk if the market crashes. You're not able to access that money because it's paper money. And so we hear again that it's only paper money, it's only paper loss on the equity. You really didn't have it. It's only paper loss on your stocks because you really didn't take it out. So when do you want to take your money out of these accounts? When you can, when you're able to do it. If you're not working and the market crashed, you're not going to get the money. If the market crashed and you are working, it's not there for you. So when you want to consider accessing money is when you're able to do it, and through a strategy of looking back. And we always want to look back at the end of what we're trying to accomplish when we leave this life. And that's how far we go back. And we backtrack to the day that we start our Discovery Lifestyle Strategy session. Where are we at and what we want to accomplish? What things do we need to put in place? What strategy that we need to work with the attorney with the tax strategy, with the investment advisor? Where do we need to put all these strategies into place to get what we want when we move on? How do we want to fund college? It's a big expense for a lot of families to fund college. So we can fund college properly through employing our house, allowing that money to grow in our side fund with the money that we normally would have put extra into our retirement accounts to have access to it. And a really neat thing about doing that is when we do that, we also allow us to have additional money in financial aid. So let's recap what we've been talking about in this session of paying off your mortgage may be a mistake. Is your house unemployed? For most of you that are listening, I would say that your house is unemployed. What do you want to do? So we want to look back at the strategy of using our house to pre-fund our retirement account, having that money accessible, liquidity, growing at a fair rate of return. But most of all, we want to have control. We don't want to be told when we can access the money, how we can access the money based on our financial situation. We want to be able to get that money anytime we want from both our two largest assets, our house and our retirement account. We do not want another entity telling us when, how, or where we can access that money. Second, we want to make sure that that money does the best thing for us. So how do we access it? Can we use it to collateralize it to do other things with? How does it become with our other strategies to become our own banker? And for those who have kids or are going to have children, how does it help us with financial aid and allowing us to put our kids to college? It'll be one of the best situations that you have for that. Now we will come back and we'll probably spend a full session just talking about money growing for our kids for college. Everyone does know that education for our kids is a passion for mine, and to allow our college kids to learn today at 19 instead of waiting till they're 47 how money works, being able to put a few dollars away every single day and having $2 million when they get out of school and they're ready to, start their job and buy their house, that they can do all these things in a proper manner by just moving a little bit of money today and look back and say, great, I'm glad I did that. Now, you may be listening and you're 47 or you're 67. Did you make the right choice 20, 40 years ago? You probably didn't. And until we meet again, keep your money safe. Living with purpose and real intent. If you're as concerned as I am, and you're not the type to sit around and wait for something to happen, there's something you can do. Special gift invitation. How to get growth, protection, and income for your money. Send a request for a special promo code to watch this new online video training series absolutely free in the comfort of your home or office. You will learn how hardworking American families protect and control their retirement money and never expose it to stock market risk or massive taxation. Watch this free video series and learn the rules. Send requests to info@citizensfinancialsecurity.com. That's info@citizensfinancialsecurity.com to view video online. Video series is shared as a public benefit for enlightenment.
As a financial strategist, William F. Richardson coaches college students, families, and businesses on income planning strategies. He focuses on how to create lifestyle benefits and retirement savings by following simple rules and proven concepts to optimize assets, preserve capital, and minimize taxes. During the Great Recession, clients of Citizens Financial Security who followed these strategies didn't lose one penny of their savings or retirement money, while others lost 30 to 60% of their life savings as the market adjusted. Assuming you've chosen to follow these strategies, there would have been zero losses due to market volatility, and your financial goals would be on track. Your money would have been triple compounding, protected, and available tax-free for any reason. Visit us at the World Economic Report at moneydoctoradvisor.com and visit our corporate sponsor, citizensfinancialsecurity.com, or call 916-500-4905. That's 916-500-4905.